and welcome to this Moneycontrol live stream. It's a raining morning in Mumbai and it reminds me of July, but still let's go on with the show. Well, over the next 30 minutes, we'll be talking about the cues for trade, the stocks that will be in focus today, and of course, we'll have all your stock-related queries answered by our experts on the show. But before we move ahead with all that, let's take a look at the top headlines at this hour. UBS's takeover of Credit Suisse and global central bank action drive a relief rally in US equities. All eyes now on the Fed, which is largely expected to raise rates by 25 basis points tomorrow as it looks to continue its fight against inflation in the face of global financial turmoil. European markets end a choppy session higher as investors digest the fallout of the UBS Credit Suisse deal. Asian markets open with a gap up on the back of strong handover from Wall Street. The Nikkei is shut today, but the SGX Nifty is indicating a higher start for the Indian market. In the latest revision to the windfall gains tax, the duty on crude petroleum will be reduced to 3,500 rupees a ton from 4,400 rupees a ton earlier. The changes will come into effect from today. The duty on diesel has been doubled to 1 rupee a litre, while that on petrol and aviation fuel continues to be nil. Well, let's go across then to our technical expert for today. Sachidanand Uttekar is joining us this morning. Good morning, Sachidanand. Looks like we are poised for a positive start today. And we did see some bit of buying come into trade in the second half of yesterday, which managed to stem the kind of losses that we were incurring till about midday or so. What is the outlook for today? Because, around midday, the entire complexion of the markets change. On a daily basis. If we are making gains, we slip into losses in the second half, and if we are losing heavily, we kind of come back or make a slight comeback in the second half. What is the outlook for today?
Good morning, Anantita. Thank you for having me on the show. So if you look at the entire sequence, I think the sequence still remains on the bearish side. Yesterday, we saw a good, strong recovery from the intraday lows. But somewhere, the index or the Nifty failed to give a closing or register a closing above its 5-day exponential moving average. So still, that particular level of around 17,070, 17,100 should act as a resistance. If you look at the 60 minutes data, despite of the fact that we have seen a good, strong recovery, yesterday's low was clearly below the 16th March swing low, which was established at 16,850. So the sequence of lower tops and low bottoms is still continued. If you look at the daily, trend strength indicators, we clearly have an evidence of an ADX, which is still trending above the 36, 37 mark, which is a sign of bearishness. Even on the weekly scale, if you look at the resistance, it is clearly placed somewhere close to around 17,240, where its 5-week exponential moving average is placed. And plus, if you look at the weekly ADX indicator, it is about to give a breakout about the 25 mark. So that is a good sign of a strong momentum which could be seen in the coming weeks. So right now, I think the stance clearly stays on the neutral to negative side until unless we don't see a closing being established above the 17,240 mark. Every opportunity on the higher side should be utilized to create some short positions. On the lower side, we are not expecting any major move below 16,600 for this particular series. So probably there could be a bottom somewhere in place near to 16,700, 16,600 kind of a zone. So right now, I think whatever the opportunity we will get in the morning, I think that particular opportunity should be utilized to create some shorts.
Right, Sachidanand. Let's also talk about the oil and gas basket. We have news flow coming in that government has slashed the windfall tax on crude petroleum to 3,500 from 4,400 per ton. ATF continues to have nil special additional excise duty. In fact, the duty on diesel has been hiked to 1 rupee a litre from 50 paise a litre. Given the fact that we've seen the likes of Reliance Industries languishing in trade, yesterday it hit a fresh 52-week low. And, it has been in a steady downtrend. Do you expect some kind of bounce coming on Reliance Industries, ONGC, etc. in today's session?
Certainly, yes, for Reliance, because if you look at the entire trading activity for the last 3 trading sessions, the put writers at 2,200 have been very dominating. Even yesterday, we saw, Reliance slipping below this particular support, but eventually on a closing basis, it did manage to register a close above the 2,200 mark. So certainly, if you look at, the 60 minutes, 30 minutes data, we clearly have kind of a positive divergence which has been exhibited, and that particular effect should be seen in today's session as well. So we are expecting that this particular momentum that has been generated yesterday could push Reliance towards 2240, 2260 zone during the day. So even right now, I think until unless we don't see a closing below that 2200 mark, we may not see any major cracks developing in Reliance. But as of now, I think yesterday's the pullback which has been resumed, I think that particular pullback could continue in today's session as well. Expect a move towards 2240, 2260 during the day.
Right, Sachidanand, hold that thought. We'll come back to you and discuss specific stocks and, of course, also take up our viewer queries for today. But let me also introduce Mr. Ajay Bagga of Elements Platforms to decode the global landscape and, where to, what to expect from the Indian markets going forward. Good morning, Mr. Bagga. Good to have you joining us on the show today. The entire landscape has changed since we last spoke. Series of bank failures in the US, Silicon Valley Bank, Silvergate, Signature Bank. And now, a bank which was looked upon as too big to fail, Credit Suisse, that has been, rescued by UBS, so to say. It's the write-off of those $17 billion worth of 81 bonds that have left investors smarting, could this be a sinister signal of more turmoil in the banking system globally, or do you think it has been contained for now?
Yes and no, Nandita. I think there is more trouble ahead. 2 weeks back, we had no clue that such a huge issue was brewing. And if you look at the unrealized losses sitting on the balance sheets of American banks of about $620 billion, that's the government figure. Private analysts adding on more paper are talking of a $2 trillion unrealized loss. But let's take the government figure as of December end of 620 billion. If you just size it with respect to how much money do American banks make in a year, that is 260 billion. So against a 260 billion profitability industry, you have unrealized losses of 620 billion as of December, which have probably gone up higher. That is the crux of the matter. It's a regulatory failure. Secondly, a 40-year great moderation has been ended with, in a 12-month period, raising rates so fast without any thought for what is happening to the banking balance sheets. I think it's all coming home to roost now. So it doesn't go away as easily. The good thing is, keeping moral hazard aside, the government and the regulators have stepped in. They have socialized the losses. Don't treat it as anything else but a bailout. No one is using the word bailout because it's politically sensitive after 2008, where profits were privatized and losses were socialized. Again, we have seen bank managements which put risk management out of the window. They have been, they have lost their jobs. But overall, because the banking is so central to the economy, they have not had, the institutions have not had to pay any price. The taxpayers are on the hook for it. So I would say it's a very sensitive, very delicate situation right now, very fragile situation. Last week, one shareholder said absolutely not on Credit Suisse being able to raise more money from them. And that started the whole vicious circle, which led to finally a 166-year-old institution no longer existing and being merged into a competitor. So that is the fragility which is inherent in the global banking. And this we are talking banking. The fourth issue is what the BIS had said, the shadow banks, the insurers, the pensions, the mutuals, the NBFCs, all the other wealth management products that have been sold. We don't know what is the cascade there. And it's not small. It is accounting for more than 50% of global financials at $227 trillion. So what you mentioned, these 81 bonds of 17 billion being extinguished, that's a 275 billion market just in Europe. You take it globally, it becomes much bigger. So if there is a run, if there is a lack of confidence, there is nowhere to hide. And these shadow banks are very thinly regulated. Nobody actually understands. We saw that in the Bank of England bailout of the UK pension funds last year, which actually brought down a government of Liz Truss. That's the kind of stuff which is lurking beneath the surface, which we have no idea. So I would say very fragile markets, waiting for some match to light up a big conflagration, a very risky market overall, and overextended regulators who are out of their depth. One final point, Nandita, is the role of social media. The $42 billion that went out in a matter of hours on last Thursday morning from Silicon Valley Bank. That was uh, a result of WhatsApp groups, of Slack, of all kinds of messaging platforms and social media, bringing depositors of a particular industry together and causing such a huge run where 42 billion out of 175 billion of deposits went out in the course of 3 to 4 hours and brought down a bank. That is what we are facing in these times of social media. I don't think the regulators are still sitting in the 20th century while customers have moved to the 22nd century.
Well, that's an interesting point you make, Ajay. You know, the Fed, of course, is kicking off its two-day meeting later tonight. You know, in the middle, there were expectations that, you know, they may actually look at a pause from what was being expected, that the Fed will be raising rates by 50 basis points, as was being expected by the, in fact, as was being indicated by the Fed chairperson. But of course, in light of all these banking failures, there were expectations that they will hold fire this time around. But once again, markets are factoring in a 25 basis point rate hike, given the fact that the Silicon Valley Bank issue was contained for the moment. So what are your own expectations? Do you expect the Fed to go in for a 25 basis point rate hike, given the fact that there is a cause for a pause this time around?
Yeah, I would agree with you. They should pause because financial stability is their first objective. But what ECB said, they said keep aside price stability and financial stability. Don't mix the two. We have a different tool set for price stability, which is the monetary policy. And for financial stability, we have a set of tools to take care of banks. We saw how messy the bailout of Credit Suisse was. The stock investors lost everything. 74,000 employees, a large portion of them will lose their jobs. 81 bondholders lost, and global banks have lost about 460 billion of market cap. So it is very costly when you say that price stability is different, financial stability is different. It's one homogeneous market. The customer looks at you as one financial regulator. They don't say when Powell wears his inflation hat, it's okay to raise rates. But on the other side, the intended consequences, the bank's balance sheet become even more fragile. The unrealized losses go up even further. And the tightness in the market, because of these regional banks going down in the US, which are a large portion of lending to individuals, to mom and pop stores, to SMEs, that credit degrowth that will come in will definitely lead to a recession. So what has happened in the US banking sector is equal to a series of rate hikes that have come in. Why have the central banks stepped in and said, we will do dollar swap liquidity on a daily basis? They were merrily doing it on a weekly basis. Yesterday, they came up and all the big banks in the world said, we will offer unlimited dollars on a daily swap window. Please come in. Yesterday, nobody came in because people would have been still assessing the fallouts. But that shows that on the liquidity front, they understand the tightness that's coming in. So most of your job is done by the market and the mayhem in the banks. 25% of market cap of regional banks is gone. Nearly about 15 to 20% of their deposits have flown out. Their ability to lend is severely impaired. Why do you want to raise rates in that scenario? But having said that, the reasoning on central banks is if we don't raise rates, people will think it's a panic situation. It will cause a bigger run. So I don't know. It's a difficult situation to be in. But right now, the Fed futures are showing a 70% probability of a 25 basis point hike. I think that's what will happen, 25 basis point hike. But the main thing, Nandita, will be what is the commentary with it? Where is the terminal rate? What is the dot plot? How do they see the impact? Because they know exactly how much deposits have flown out from smaller banks to larger banks. They know exactly who's sitting on what tinder box. So we will look forward to that commentary and the press conference to give some direction. What is the terminal rate? Markets have said, okay, it's inevitable. They will raise rates today on Wednesday, but they will not raise any more in this cycle. And guess what? Rates fall from June by 25 basis point, and they fall nearly 1% by December. So why raise today if the rates have to come back in June? Because the economy will be stalling. That's the big question mark. So let's see what they do in their wisdom.
Right. My last question to you, Ajay, is, given the kind of volatility we've seen, we are stuck in that range of 16,800 to 17,200. Where would you call a bottom? Because, we are reacting to global cues. We did slip below that 16,900 mark yesterday. For the coming weeks, do you expect us to break below that 16,800 level, 16,500? Would you call that a bottom, or, is there more to come?
Yeah, so far we were still saying that the Indian fundamentals will hold us up and, all those things. Indian macro is much better. So I would say stick to domestics. It will be a very particular stock kind of. I don't want to use the much misabused word stock pickers market. Whenever we don't understand markets, we say it's a stock pickers market. I would say I am very cautious on the market, more because of global, not domestic. Domestically, we are fine. But as we have seen in multiple crises, right, from 2000 to 2008 to 11, 13, 15, 18, 19, 20, every global crisis brings out a sell-off in the Indian market. Second, very big thing, Nandita, is the FIs continued selling. So they are, if they have to fund liquidity elsewhere, the Indian market is open at a low impact cost to take out as much money as you want. That's something that mitigates against us. So they are giving money to the Chinese communists who are grabbing all the institutions in the country and making it fully subservient to the Communist Party diktats, not capitalist diktats, what Deng and all the other reformers had wanted. They are funding those, but they are taking money out of a market like India. It is folly, but it has to be borne, and that keeps our markets down. In terms of a bottom, very difficult to say. I think Sachit would be able to give a better idea on technicals. But if it falls, then no levels are sacrosanct. If there is a global sell-off, and that is the big risk. Today, in terms of risk reward, your reward is very limited. It's not going to run away to 19,000 or 20,000 kind of market. It's a range-bound market at best. And on the downside, it can fall 15% very easily based on global mayhem. So I would say wait and watch, cautious for now. Let this banking mayhem in the US work out fully. Give it a couple of weeks for us to see how is it emerging. What happens tomorrow is very important, but be very cautious is my small piece of advice.
Sure. So be cautious. That's advice coming in from Ajay. Ajay, with that, I would love to have a longer conversation with you, but we're running out of time. Thanks a lot for taking out time and joining us this morning and putting things into perspective. Let's go back to Sachidanand then. We're getting a lot of queries on the banking stocks, this morning. In fact, Jefferies has also come out with a report which says that after the kind of correction that we've seen in some of these banks, the valuations rather are now near or below the below COVID levels. Would you advise investors to look at something like an SBI now? We are getting queries on our live feed. Trilok has written in and he wants to know what he should be doing with an SBI for the short term. So give us a sense of what one should do with banking stocks now.
Well, Nandita, I think the structure still remains weak when it comes to Nifty Bank. If you look at the entire data set from last week, we saw a very strong breakdown below its 200-day exponential moving average, which is placed at around 40,000. So if you look at the last three instances, this particular level was held on. After that, what we have been observing is that the Nifty Bank is again consolidating. We have really not seen any strong, pullback moves as of now. So the immediate, resistance is well defined at around this particular level of 40,000 unless we don't see a closing getting established, at least on the daily scale above this particular level. The revival in banks would be difficult. So if you look at something like an SBI, clearly, this particular bank has been one of the leading banks when it started correcting. Even right now, it is sitting at a very important support zone of around 520, 515. In case if this particular support zone is breached, we don't see any major support before the 500 mark. So immediate basis, I think, we may see a move towards 500, but that particular move also should be monitored because the major trend still remains weak. But somewhere down the line, I think 500 would be one particular level wherein the entire trend could be reassessed for any accumulation, signs. But as of now, I think the trend is weak. The 530 resistance should hold on.
Trend looks weak. I have one particular stock I want to speak about. That's Ceat. We've had management change when it comes to the company. Anand Goenka has resigned as the MD and CEO, and Arnab Banerjee has been appointed with effect from 1st April for the next 2 years. If you look at the shares, over the last 1 month, it has shaved off somewhere around 8 to 9%. What would you say the charts are looking like now for a company like Ceat?
Well, the immediate trend still remains weak. If you look at the support levels, it is just closing to that particular support of around 1350, 1330. So right now, I think it's better to wait for a reversal to shape up. Immediate basis, so the resistance is clearly at around 1480, where its 200-day exponential moving average is placed. If you look at the daily indicators, we are seeing some signs of a positive divergence, but I think that particular effect will only kick in once we have a stable closing above that 1450 mark. So as of now, I think it is better to watch out for these levels and deploy a trade once we have the confirmation on the higher side.
Right. The next stock that I want to talk about is Bajaj Finance. It was the top Nifty laggard in yesterday's session. We have a couple of queries coming in on this stock. Deepshika has written in fact, she has 20% of her portfolio in Bajaj Finance at the rate of 6,340, and she wants to know if she should average or move on. In fact, even Karthik Raja has written in and he has a query on the same stock. What would you advise investors to do now?
See, averaging is recommended once we have clarity on the trend. So even right now, the trend, at least on the weekly charts, is still bearish. If you look at the structure, we have 5350, 5360 kind of a zone where it's 200 weekly exponential moving averages placed. So probably that could be a level wherein we may see some stability in the prices. But as of now, it still continues to correct. Yesterday we saw a fresh breakdown below that 5700 mark. So probably, this particular move should continue towards those support levels. So 5300, 5350 would be an ideal zone wherein the trend could be assessed.
Right. The next query comes in on Tanla platform, and Suresh Shankar has written in. He wants to know your thoughts on this counter. Now, this stock has shaved off somewhere around 25% in the last 6 months. More weakness on the charts now, or what should one do?
Well, it's a very thinly traded counter. Even on the weekly and the monthly scale, there is no sign of strength as of now. So probably, once we see a reversal getting established and a price breakout confirmation above 625, 630 zone, then probably we can be in a better position to assess the trend. As of now, the trend remains weak.
Well, the trend remains weak for Tanla platform. Another counter I want to speak about is PVR. Now, we did see some fund action in this counter. Warburg Pincus has also shed some stake. In fact, but domestic mutual funds like ICICI Pru MF, SBI MF, SocGen, these have picked up stake worth 380 crores in this stock. What would you say this stock looks like now, PVR? Would you expect the stock to head higher from here, or should one avoid this counter completely now?
Well, if you look at the weekly charts, we are getting signs of a stable price action after a corrective move for the last 2 weeks. We have seen consolidation. On the daily scale, there is the possibility of a double bottom formation. The confirmation will set in once we see a swing back above the 1580, 1585 mark. So as of now, I think the price is stabilizing. Probably we may see a relief rally towards 1650 zone soon. So I think declines in case if we see towards 1500 can be accumulated. Overall, the expectation is that the move could again resume on the higher side. Probable targets are placed somewhere close to 1650, 1680. So.
Right, the last query for the day, this one's coming in on Tata Steel. Now, metals have seen quite a bit of correction, but the view on the street is that, they may be looking attractive after all the kind of correction that we've seen over the last few weeks. Would you advise investors to look at a Tata Steel now?
Not at this level, but certainly yes, somewhere close to 105, 195. This particular zone could be an important zone. As of now, 105 still looks like a resistance even for today's trading session. We've already seen a breakdown a couple of days back. I think probably we may see a follow-through action here. We are expecting a move towards 100 zone soon, and probably the major bottom is placed somewhere close to 95. So I think 100 to 95 could be a good accumulation zone.
Right. Well, this wraps up our query segment for today. We're running out of time, but Sachidanand, leave us with some of your stock recommendations for viewers.
Well, two stock ideas. One on the long side, clearly, IOC is something wherein the price action has been very stable on the higher side. We already saw a good short covering move in yesterday's trading session. The placement of its averages plus the breakout from the channel pattern is exhibiting a price target somewhere close to 85. So we are recommending long positions here with a stop loss at 679. And on the short side, Havels has again displayed a breakdown. We are expecting this particular move to continue towards 1140. So from a trading perspective, 1200 resistance should hold on. So the stop loss should be placed at 1205 and fresh shorts can be deployed in Havels.
Right, so sell call on Havels and a buy call on IOC. With that, Sachidanand, thanks a lot for taking out time and joining us this morning and answering all our viewer queries as well. Well, with that, we've come to the end of this edition of Morning Trade, but don't go anywhere because coming up next is Opening Bell. It's a goodbye from me.